Last time on the Market Snapshot.
The Home is Possible program and the Home It Lasts program. That's if you don't have a down payment or if you don't have closing costs that will pay for it. I'm qualifying somebody right now. They got like $40,000 in the bank. And they said, Dan, I really want to hold on to my money. They're getting $15,000 roughly for down payment. Are you okay?
Yeah.
All right,
This
you
is
can breathe.
funny. This is just funny.
You're turning red, and I think
Talking
you're...
about taking advantage of the system.
Hey.
Oh man, go ahead.
And they're getting closing costs paid by the seller. And the seller's paying for the appraisal.
And you're paying for the inspection.
So they're coming out of pocket. Their earnest money deposit might be, I don't know,
$2.
There is no middle ground in today's housing market.
We started seeing a climb.
Sales of existing homes rose sharply.
So the homes that have been selling are at a higher price.
Let's begin.
All right, in 3, 2, 1.
It's time to cut through the clutter.
Refinancing your home loan.
This is your source for the latest real estate and home financing news. You can actually use.
My prediction is that most predictions will be wrong.
It's the Market Snapshot.
Going live.
And now, here's your host, Dan French.
Hey, welcome to the Market Snapshot. It's Dan French from Nova Home Loans, your go-to mortgage specialist here in Las Vegas. In studio, as always, with the devilish laugh that he had starting the show, Chakits ITZ Krulsawat from Simply Vegas. Chakits.
Yeah.
Chakits, what's going on today? ITZ, baby.
So, explain to the listeners. We came into the studio. What happened?
Oh, it was all bad. It's like I'm walking in and you know how you got that comfort zone in the chair that you're in? And you got that whole connection with the producer and you, and it's just like there's that certain angle that you just kind of get accustomed to.
Yeah.
I'm turning different angles today. It's like I'm over here looking. Yeah, exactly.
So we got a pre-bonata.
My makeup artist wasn't ready.
Mike's not right. Sitting next to the wall.
It's one of those things where it's, you're sitting next to the wall and you kind of feel like you're in a cubby hole. That's where I feel like right now.
And you were like, I didn't want to sit by you, Chuck.
No, I don't want to sit by you, Chuck. I need my space.
You ain't that big.
I know, but I just need my space.
Huge.
I need it. I need to have my workshop right here. That's what's going on. So, it is what it is. I mean, I'm not unhappy. But it would have been good information to know coming into the studio to be ready, right?
All right, Howard.
Yeah, right. So why not purchase a home with rates still historically low? There is a tight supply of inventory in Las Vegas going on right now for home purchasing. An article came out in Las Vegas and has indicated that there's a tight supply of properties, which does indicate regressed home purchasing. Well, maybe we're heading into a slower part of the year. Also, families are now preparing to get their kids into school, and maybe the focus isn't purchasing a home right now. You got football going on, the American tradition. And, maybe looking at purchasing a home or financing and things like that are kind of put on the side here. But I got a different thought. And we've talked about this numerous times on past shows. What if you're just flat out bought out of the market? What if you can't buy a home because you don't make enough money? You have a lot of people out there that are looking to rent. Rents are pretty consistent when it comes to renting versus purchasing. And, if you look at the properties that's out there, they're still out there. It's just the fact, are you bought out of the market? If you're bought out of the market, you know that there's a commitment to that.
Yeah.
Purchasing a home. It's like a marriage. Mm-hmm. It's a long-term investment. It's a long-term thought process where if you are going to purchase a home versus rent is temporary. You're looking at a very short window. So if you don't find a house you want or you can't qualify for the home that you want because you can't afford the home that you want, that's why people are forced to rent in some cases. And that's why you see, in my opinion, a lot of stagnation going on in the housing market right now. What do you think?
You don't think it has to do with school starting up this week, Monday, and football season, winters coming by? And
I think all that plays a very small part, but also you have to look at, is purchasing a home right now, is it affordable? We talk about every week gross domestic product and inflation and the average cost it takes for somebody to purchase a home. The average purchased home right now is what, 235 or 239?
Actually gone up, but
Yeah.
we'll talk about that.
So
later on.
it's going up. So as that goes, your purchasing power decreases. So I don't know if that is all these other factors is really what's going on. My opinion is, yes, all three of those things we just talked about do play a considering factor, but I think also the big factor, you have new homes coming out, existing home sales are down. It's all because really there's not a lot of buyers out there that can afford some of these homes. We're almost at the 2007 numbers right now.
Well, let's figure this out. And it's very interesting that we're actually talking about this right now because I read an article here on Facebook a couple weeks ago, and it talks about the salaries that you need to buy a home in your area. So, like, if we take a look at California, just to get into the median price, you need to at least make $92,000. Portland, $70,000. Sacramento, $65,000. San Francisco, $165,000. Let's talk about New York. New York, you need to make at least $160,000. Let's break it down.
Yeah.
Las Vegas, we know that the median price right now is at $235,000 for an 1,800 square feet home.
Right.
3 bedrooms, 2 bathrooms. Okay. For $235,000. How much money do you literally have to make to qualify for something like that?
Well, you have to qualify for the payment. I mean, that's just bare bones minimum. You know, it's not saying additional trade lines or credit that you have, car payments, credit cards, and all these other things.
Let's figure this out for an average person. Here in the state of Nevada is at $51,000 per household.
Right.
Okay. So let's just say at $51,000 per household, you got a car payment, $300. What else do you have? Is cell phone bills, probably another $100. Let's say you have expenses $1,000. Okay, not including the rent.
But you got to realize we hit just for installment or trade line that shows up on your credit. The only time that stuff like cell phones, I mean, you got to put that in consideration.
Yeah.
You got to put what is the cost of water and all these other things. But that's not really something as a finance person I'm going to look at. I'm going to look at things of what is the long-term commitment or commitment that you have on a monthly basis, and then average it with the new mortgage.
Okay, so out of all the loans that you've been doing, obviously the average is at 51, and you can see with their files as far as what the average is. What are they normally qualifying for? Average.
Well, here's the thing. It depends on everybody. I deal with a lot of different types of clients. Okay, it's not just I try to go to a specific niche of clients that I work with.
understand that.
But I would say that it's an average is about 225 to 260 of what I deal with. Now that's the meat and potatoes right there of what I'm doing, because when you start to get to the 400s and the 417s or even the high 3s, there's not a lot of people that can qualify for these loans. I mean, it's a very small margin, and so most people are coming in just being a two-family purchasing or two-family commitment of purchasing a home. You got both of those people working typically now.
Yeah.
The spouses or the spouse and the person buying the home. And so when you're out looking to purchasing a home, the amount of home you have to purchase now just to get into I would call it a average median price home, which is what, 239 or 245 or something along those lines. It's going to require a lot more from you. And also your purchasing power decreased as far as how much home you can purchase, because that's just the starting point.
Yeah.
I had somebody come in this last week and they got into a contract. This person makes $20 an hour. Now, if you go back, 3 or 4 years?
Yeah.
I'm not saying that that's going to set the world on fire, but that's a pretty decent hourly pay.
Not only that, you can actually buy more home because it was cheaper.
Well, and that's the truth. So when you have $20 an hour, let's bring this out of a hat here with this person that I'm working with.
Yeah.
They're $20 an hour. They're trying to purchase a home. That same purchaser that they could purchase a home 4 or 5 years ago now needs somebody to come on the loan with him. And I had to have somebody come on to help them purchase the home. They're purchasing only at $225.
Now, at $225, what kind of payment is that?
That's about a $1,200 payment.
So let's break this down. If you're making $20 an hour, 160 hours a month, that's $3,200 a month.
So let's say this. You can still qualify for it,
Yeah.
but at the same time, what if you have other things like car payment?
Yeah.
Or what if you have student loans, which a lot of people have, because everybody's been put out there that the stigma to get into a higher education is going and getting loans and then trying to get financing.
So
financing, but getting the education. So
the point that I'm trying to get to here is with this article is if you're making $51,000 a year, and that's the median for Nevada, and you don't have no debt, you are still in a great position to buy a home because the median price is only at $235 at this time.
But if you look at it, is the average wage earner or even somebody that has some type of skill, is it starting to get to a point where they're bought out of the market?
Not right now, they're not.
Well, I feel like in some cases with my clients that they have been, because I've had to let them know that they don't qualify on a more, it's basically on a bigger basis here, on a basis where they have to look at, do I either ask somebody to get on the loan, or do I just wait and hold off and see if I can either, put a larger down payment, or am I just going to rent?
Here's the thing. They are qualified for the home. The issue is that consumer, for what they are qualified for, what they are looking to purchase, is just no longer out there. You have to understand sometimes the consumers are not educated enough to understand what you can get for your money. And a lot of consumers always want the Taj Mahal. Unfortunately, you can't get the 10 out of 10 things.
Right.
You have to get the 6 out of the 10 things.
It always comes down to this, Chuck. We bring up this every time almost on every show, and we always say, is it a good time to buy? And, that's your personal decision.
Yeah.
Buying is a very, it's like a marriage. It's a long-term investment, but at the same time, there's a lot of incentives. If I'm going to buy or versus rent, I'm going to buy every time. But what you have to look at is, if you buy a home, what is the payment going to be? I think a lot of people look at, and then
that's the first thing they look at.
What is it going to be compared to versus the rent payment? Because you see, if you look at the numbers, rent and mortgage purchases are almost identical, very close to how much increase has happened over the last few years.
Yes,
it's not been a huge difference. So a lot of people still have to rent, but I just think that, is it a good time to buy? Absolutely, because historically rates are still low. If you could still purchase a home and you can get into it and you can still put your money to work for you, I think that's what a lot of people don't do, is like look at the idea that your money's working for you so long as there's appreciation and as long as rates are still low, because guess what? Your payment is relatively still low compared to what you're purchasing. Really, we should be in a market of 7 to 8%, or maybe a little bit higher. I mean,
I would disagree with that, but go ahead.
Yeah, well, listen, our market can't stay this low forever on rates, because it's just doing nothing but causing more printed money, and they're putting QE4 out, going to be putting QE4 out. So they're just going to be on a consistent basis of extending out the problems we have by printing money, which in essence has to keep rates low. So I don't see why they would raise them. They're not going to raise rates. So, I mean,
they can't.
They can't. So at this time, I think anybody out there that's looking to say, is it a good time to buy a home right now? Yes or no? I think it is. And I think you have to look at, what are you getting on that return on investment versus renting? Well, there's a lot more incentives by purchasing a home.
Now, I want to tell you this story. There was a client that we actually worked with. I'm not going to mention names, but Mrs. Clark, she was actually approved for a certain dollar amount. So we sat down, we went through the whole consultation process. We looked at a couple homes, but in their circumstance, they realized right now is not a good time to buy, because it was based upon their situation, because they may be leaving in the next 2 to 3 years, because they don't want to live here forever, but they are considering buying just due to the fact that it's a lot cheaper than actually, paying rent to somebody. And I think they were paying like $1,600, and they could actually get rent for like $1,200 a month, and that's what they were considering. Not only that, one of the perks was if they decide to move, they were going to rent out that property. And that's where it really comes down to really case-by-case basis.
Well, but there's commitment, right? Everybody looks at what is commitment. You have commitment in marriage. You got a commitment in life to your kids. You got a commitment in life just to your family, which is it's all expected. But when you have a choice, I think a lot of people steer away from commitment. They don't want that commitment of purchasing or owning a home. And I don't know if it's because of the things that they've seen from other situations, especially recent, where you see family members having issues, where they're losing their home, foreclosure, they're upside down, all these things that's gone on in the turmoil. Is this generation looking at it going, well, it's not that important, even though it is cheaper, even though there is a bigger or better return on your investment purchasing a home and having a mortgage, just like Mrs. Clark. I mean, they've been down, they're not the youngest. I mean, they've been down the road where they understand life, where maybe they've seen, because listen, these markets are always up and down,
especially here in Las Vegas, because it's so trendy.
Right. And so you see the up and downs. They know it's going to go up. They know it's going to go down. So at this point, maybe they have a little bit more experience on understanding that it's still a better situation to buy a mortgage, even if they're going to leave or possibility of leaving.
Not only that, we can't predict the future. I mean, we don't know if the market will even drop. We could look at this, forecast 6 months from now. we could be another 10%
well,
more.
If they keep printing money, and they're not going to do anything anyways until election. But if they keep printing money and keep the path of where they're going, all they're going to do is create that bubble to be bigger.
Correct, and it's going to prolong.
Right, it's going to prolong. So
yeah.
Is it going to happen long term where this thing could bust? Sure.
Now that you're saying that, as I'm listening to you, now you're basically telling me maybe I should wait till the elections. Am I correct?
Well, I don't know about waiting to the elections. I always say that money's cheap, so I don't think the elections is going to make a big difference on purchasing a home because they don't.
Yeah.
They're not going to be like, well, we're going to now lower rates. They're going to cut rates, I think, because they can't afford to raise rates. Yellen, we're going to talk about this in a second. Janet Yellen, the Federal Reserve Chair, she came out and at a consistent basis says there is a possibility of rate hike. Now possibility
means that they're going to do it.
No, here's what it means. It means that they can't, because if they were, they would already done it. How many times have they come out? The reason why they bring this up is because they prop the markets. If they prop the markets where it says there's a possibility, then it keeps all those investors or all the people that are in the stock market, it keeps them where they're still trading because they feel like, well, there's a still possibility.
Yeah.
And if they don't do that, then we'll really find out how bad the market is, because then all of a sudden the stock market and the trading that's going on is going to start to decrease.
Yeah.
That's why you see the stock numbers going up so much recently.
Yeah. But here's the thing. I think they may tick it up another 0.25% by the end of the year. But now when elections come by and they do the QE4, now they're going to do the QE4 and print more money. In addition to that, now they're going to drop rates back down to zero or even down to negative.
And how does this all affect you as a consumer? Well, I mean, this is good information so you can kind of prep yourself the next 6 to 12 months about what you're trying to do. I mean, if I'm listening to this radio show, what I'm getting from it is I'm getting the idea that rates are going to be relatively pretty low, that buying a home right now is going to be good, and I don't see a foreseeable time when it's not going to be because rates. But I also have to put in consideration that there is a appreciation going on in homes, and that the value of these homes could be putting me out of the market because I can't afford to buy some of these homes. I got to ask my brother or my other family member or somebody that I know to try to get on this loan just so I can approve for a home at $260,000 or $270,000, which is barely above now the average median price home. I mean, that's not buying some luxury home. Imagine 5 or 6 years ago how much $270,000 or $280,000 would buy you versus now. I mean, it's astonishing. Stan French with the Market Snapshot. Stay tuned. We'll be right back. We have a whole lot of show left. Chuck's going to talk to us again about the market, what's going on with Las Vegas here. Rates, they have been trending. They've been ticking up here and there. Also, they got a revised numbers on the GDP. We'll talk about that when we get back. It's Stan French.
They're broadcasting live and streaming on every platform imaginable.
Oh my God! Score! Score! Score!
It's the Market Snapshot on News Talk 720 KDWN.
And welcome back to the Market Snapshot. It's Dan French from Nova Home Loans, your go-to mortgage specialist here in Las Vegas. I wanted to let everybody out there know, thank you for tuning in. We're here every Sunday from 11 to 1 p.m. on KDWN News Talk Radio. And you can always visit our website at danfrenchloans, LOANS.com, danfrenchloans.com. You can also find our podcast. We have an iTunes podcast, The Market Snapshot, of all the shows we put together. And, it's been very good. I mean, we've seen a lot of subscriptions. Also, you can find us on YouTube. I have a library of past show videos that you can look at as well. So you want to take a look at all that good information. And you know what? If you text 6682 to 55,000, I will take your information, and we have a free credit services department. I'm going to have them look at your credit report for free and to see if they can help you get your credit rating up, depending if you want to buy a home. So if you're out there and you think you have some poor credit, we can do a soft pull on your credit as well, so it doesn't require a hard hit, and we can just kind of see where things are at. A lot of times I get people that go on the website and, Credit Karma or things like that. I'm not saying it's bad, because it's always a good indication of kind of where things are at, but it's not the up-to-date exact time frame of when you get your credit pulled.
So what you're saying, you can't use that credit score from Credit Karma.
Well, listen, what I'm saying is you can use it as a barometer, but it's not the exact credit rating that you will be getting.
So something that you ain't going to use.
It's not something I'm going to use. I mean, listen, everybody's got their own bureau, the credit agency that they pull credit with as far as a mortgage company. There's a few of them out there. But the thing is this. It's not about what type of credit or when we're pulling it. It's about what's going on at the time that we pull it, because that's the most update information that you're going to get. Because if you think about it, that stuff could be delayed. It could be delayed a few months, especially like on the Credit Karmas or the other places where you can go and look at your credit rating online. That's all great. I'm not saying don't do that, but realize that a lot of times, I'm going to say 90% of the time when I go on there and I pull credit, people are like, well, man, my score was a lot higher than what I thought it was. Well, it's because maybe they just didn't update your bureau or the bureaus
that you're using
consistently.
Yeah.
So right now, if you text 6682 to 55,000, I'm going to give you a free credit analysis. We're going to get you we're going to sit down and we're going to have somebody call you and talk to you about where your credit's at. We could do a soft pull on your credit. And if you're those people out there that are like, I'm a little scared because I don't want somebody to pull my credit, or I know I have a ton of debt. Hey, if you're at a 500, we can get you to a 620 or 640. It's up to you if you want to do it, but that's a good thing to do is text that, get started with that. We can get you help. I mean, there's credit services out there. That Nova Home Loans Credit Services will help. I mean, we help a lot of people, but again, you have to help yourself. It's not us just going in there and holding your hand.
So does the soft pull hit your credit pretty hard, or?
No, it's a soft hit. So they just kind of give you an idea about what it is.
Yeah.
Or, and just kind of give you kind of a starting point, but they're not fully hitting it as a hard hit on your credit like an inquiry.
Gotcha. Now, you also mentioned it depends which lender that you are going to, which credit system that they use to pull your credit. And obviously, that's very important as a consumer, because if you have a credit score of 720, I'm sure that you're probably going to have a pretty better interest rate versus
Absolutely.
At 640.
And that's a good point.
Let me ask you this. So if I went to you, wouldn't I want to know what type of system that you're using and how much money I could qualify for? Because I can go to a different lender and they can use Credit Karma and it's a higher credit score. Do you see what I'm saying?
Let me say this.
Is there a regulation between that? I mean, there's got to be.
Let me say this, okay? Everybody out there does not always pull credit because it costs us money to do that.
It ain't free.
And it's free to them if they want to go online and check it out. But for us, it costs us money to pull credit. So we're pulling it at the time that something occurs on their credit.
So you don't charge the consumer?
I don't charge the consumer.
There are some lenders that do charge.
Absolutely.
To pull.
And that's called
I do want to mention that.
Yeah, there's miscellaneous fees out there that you want to take a look at, especially getting a loan estimate.
Yeah.
But the bottom line is this. We are helping you in any way, shape, or form try to get you into a home. There's really no reason why you can't. It's just because you don't want to. Now, if you don't want to purchase a mortgage, your mindset's not there. Maybe you're focused on other things that...
It's too hard.
Well, it's not just too hard, but maybe it's just not something that was instilled to you, or it's instilled that you want to purchase a home. I understand that.
Yeah.
But at the same time, for you, the ones that are out there that could take advantage of that, I highly recommend it. You can also go to our website, danfrenchloans.com. You can start an application process there, and I can also submit directly into Credit Services, Nova Home Loans Free Credit Services Department, to start the process there. You just have to go there and hit apply now. It takes about 15 minutes. The point is this. I've had somebody last week come in and talk to me, and they said, you know what, I'm at a 620.
Mm-hmm.
I want to get for the grant program, the Home is Possible grant program. I said, unfortunately, you're not there yet. Okay, you need to be at a 640 or higher.
Yes.
And then we're going to go over all the options and guidelines and what you can approve for. And by the way, that grant program is exceptional. You have all the down payment assistance programs out there. I think that's the best one that we've seen. It has no restrictions, and it's very lenient. 95.5 is the cap. 640 score or higher is what you're looking at. So looking at all of that, you want to take a look and see, well, what is it going to take for me to get to a 620 to a 640?
Yes.
Well, it was very minimal. Okay, they're paying off one account and settling it, and then they're going to take a balance on a credit card and lower it. Now, I understand that seems pretty simplistic. Okay, but it's not about it's about what to do, not doing what is needed, because you might not know what to do to get there, and I think that's the part of it. It's
and
the
you're
blueprint.
not the professional,
right?
Sometimes I'll have a consumer. They're like, hey, Chuck, I don't want to talk to a lender right now because I'm just going to fix my credit. But why are you wasting your time? That's not your field.
Absolutely.
You're not a professional.
Again, 6682 to 55,000. Text that number. We got a free credit services. Take advantage of it now. I have more people on staff for our credit services right now to try to help anybody out there that's looking to help their credit. A lot of people out there, they're like, well, I'm being charged $300, $400, $500 a month just so I can get my credit score increased. Remember, a lot of these credit agencies, I'm not going to say all of them, but a lot of them, what they're doing is milking that money. They're milking you until you can't breathe, right?
So basically, you will go to a lender. the lender doesn't have some sort of in-house credit service financing, whatever it is.
Most of the time they don't.
So
I'm going
what
to
they
say
do
9
is
out of 10.
they probably work with a third-party company.
Yeah.
And that third-party company will charge you a fee, but you have to understand that that company makes money by charging you a fee every single month.
Absolutely.
So it wouldn't be in their best interest to help you fix their credit right away. Not only that, I do want to mention this because we are working with a couple clients like that, and we've helped them out. One of the things that they do is they automatically dispute the charge. That is such a rookie mistake. You don't always just dispute the charge.
No. You know, and I'm going to say one thing about it here, okay? Look, everybody out there deserves an explanation of why they need to do something, right?
Correct.
So if I was going to get my credit repaired or serviced, wouldn't I would ask them, why is this needed? Why is this needed? Like, what is the purpose of me doing this? Now, realize this. There's things that come on your credit that directly impact your credit, but after 12 months, it starts to diminish of how much it's affecting you.
Yes.
These are the things that people don't understand, but yet they'll go back and tell you, hey, still take care of this. It's only 12 months. 12 months is, I don't know, let's say it's 14 months out. That might not even be necessary, but they'll still tell you because they're still getting paid. And that's what it's at.
Not only that, when you start disputing those type of charges, you are kind of reactivating that account.
Absolutely.
Now you have to go backwards if you are serious about getting a loan. You have to untwine everything, and that's going to even take a little bit longer.
Yes, that's exactly right.
We've had that happen so many times, but after we explain to the consumer this is how it really works, light bulb goes off.
Light bulb.
I get it.
Yeah, and I'm going to say...
matter of fact, we're under contract right now. I don't want to mention names, but congratulations, Ruben, for his new home purchase. We're under contract right now. Same situation. We're making it happen.
Yep, and that guy had a disputes on his account.
Correct.
What happens on disputes? It drops your credit rating because it puts it at freeze mode. I can even find out from my credit services how quick they can get their score back up and exactly how much it's going to drop. It's not exact, but it's pretty darn close. I mean, it's something where I can have the confidence to tell somebody I'm working with, this is what's going to happen. And I'll tell you, more often than not, it's pretty darn close of what's happening. So the other thing I was going to tell you is when you brought up the 720 score, there is tiers out there for how your credit rating, especially on conventional loans, you get to a 740 or higher, you're in that league of just top tier. You're getting that top level service.
Oh, yeah,
you're getting
baby.
that top rate. That's pricing that you're going to get is better than just average by far. So you want to take a look at that, including if you have a good credit rating, but then you're putting a larger down payment, your interest rate might even get better too. Let's say you're putting 25% down or more instead of just 20%. I got an investor right now. He's at a 748, and he was putting 20%.
But 25% down.
25% takes a little bit more off the bank. What's the bank going to do? Well, they're going to turn around and say, you're taking risk off me. I'm going to give you a little bit better pricing.
And if he's buying it based upon cash flow, his return on investment is going to be a lot higher. And that's where, you run the numbers to see if it makes sense. But I want to jump into this real quick. You mentioned that there are all type of programs out there. One of the programs, what was it, the grant program?
The Home is Possible program.
You said that that's one of the great programs because there's not a restriction. Elaborate on that. What do you mean by restrictions?
Okay, so when you look at all these different down payment assistance programs, I got one guy that came to me last week. Let me give you an example. This guy started with NACA 4 months ago.
They're so hard to get a deal done.
Let me just tell you, he didn't even know what he qualified for. He called me and goes, listen, it's been 4 months in the works. He goes, I don't even know what my numbers are qualified for. He goes, I'm trying to purchase a home at like 260.
Yeah.
I was like, okay, well, what did you talk to them about? He goes, really, I didn't talk to them about anything. They just took very general information. They don't have any of my paperwork. They don't have anything that I have. And I said, okay, well, why don't you send your stuff in? I'll look at the Home as Possible. If NACA works out for you, great. Stick with NACA. Guess what? The guy qualifies for $110,000. Okay, with his current debt, including what we can use, he's a truck driver.
Yeah,
they make good money, but a lot of it's inconsistent on a monthly basis. It's not always the same.
Yeah,
they go with mileage and things like that. So he qualifies for probably $110,000, and he's going, well, why didn't they tell me this? I've been in this thing for 4 months. If you go through the Home is Possible program, you're going to know right away where the issues are at.
Because he's trying to get some free money. Because obviously, NACA program, you can literally get into a home.
Well, he's obviously trying to get the down payment assistance program. But the bottom line is that if you go through a process 3, 4, 5 months and you really don't get any type of progression and you don't know where things are at, why the heck would you stick with it?
Not only that, imagine this. You started at the beginning of the year. It took you 6 months to find out if you can even get a loan through them. 6 months. We've already increased by 6.8%.
Absolutely.
That's how much money you're losing by not taking actions now.
If rates increase, so does your payment.
Yeah.
So if you're looking at all these things, Why would you go to the Home as Possible program? Why would you use Nova Home Loans free credit services? They sometimes work hand in hand because you're going to get answers right away. You're not going to get somebody BSing you behind the scenes about this is what you need to do to get your credit up, or let's get your information like it is for NACA and say let's go through the process when there's so much stagnation and so much inconsistency. You come to me, there's going to be more consistency, and I want to give you results because you know what? What's the most important thing about our business, Chuck?
Referrals
and reputation.
That's correct.
That's right. So let's go right into the market rundown. Are you ready for the market rundown, Chuck?
Let's do this.
So, honey, what are you going to rant about today? Can we get a little preview?
It's the market rundown.
And always, we start off with news and events. We're going to go over news and events. We're going to talk about housing market with Chuck. That's why he's here. He's the guru behind the scenes. And I'm going to talk about interest rate trending. We're going to bring up home values rise for the 48th straight month.
48.
The hottest market in August. We're going to go over that. You want to stay tuned. Also, Yellen hints about rate hike. We're going to brief over that. I'm sure everybody from this show always hears about how we talk about Yellen and rate hikes and all these things. But you know what? It's good to just kind of get an idea about where that consistency's at. Really, nothing's changed, but we're going to talk about that as well. So let's go right into news and events. One of the things is we talk about some people that are going to be performing here. And, one of them, I don't know if you've heard of them, explosions in the sky going on today at the Brooklyn Bowl. You're going to go to that, right?
Yeah.
Anything with the word explosion?
Mm-hmm.
What are you doing over there?
Exploding.
Yeah, right. All right, so also Jay Mueller's Winter Dance will be performing today at the South Point. What is a winter dance? I mean, we're still in summertime. He's wanting to bring winter to us, right?
Yeah.
Is that why there's a dance? Is he going to do like that Indian dance where it's like you're going to bring the winter, you're going to start it early? You know what I mean? Like, what's going on with that?
Where are you getting all this information? Because all these people, I don't even know. Hey, I'm a millennial.
Hey, listen, I'm an avid. I'm somebody that looks at what's going on in Las Vegas every week, and I make sure that I'm hitting all areas because I'm not going to be just that one narrow-minded person that's like, oh, it's just got to be here and it's only got to be this. No. You know what? If I want to go talk about, the new flower that's coming up, I don't know, something.
How'd you get flour?
I don't know. What about the new rocks that are painted? Maybe I want to talk about that.
Hey, should we go over there and kick off the rocks? Kick down the rocks.
Hey, there's a lot of graffiti on those, I heard.
Oh, that's messed up.
Yeah, $2 million later, is it?
How's that $2 million?
I don't know.
I can go buy a bucket of paint. Give me $1,000. I'll paint it for you.
You're going to put your CK group on there? Let's talk about financing news. We talk about a lot of things. Oh, but one other thing. You've heard of the Deftones, right?
Yeah, I think so.
Okay, well, they'll be performing on Tuesday. So anybody out there that's a Deftones, and that's a big band.
Mm-hmm.
All right, they were been around for a long time. They're kind of like Metallica.
Are they pretty demonic?
I don't know. I don't really listen to them. But here's the thing about it is that everybody thinks that everybody's going to stay the same as an artist.
Yeah.
Right? Okay, if I put out the same music, put out the same information, you have to adapt with times, right? So
Correct.
People don't always look at the idea of, well, why is this sound so different? Why are these changes going on? Because they're trying to change and make something different. I wouldn't want something the same every single year that something comes out, right?
You're right.
So I don't know. You just got to adapt with change. But I'm not saying that their music's changed, but a lot of these artists out there, they get a lot of flack, like Metallica and all these people where they have their music that's different now, but it's not because they want to, I wouldn't want to be the same person. I mean, that's just bottom line.
Trend changes.
Trends.
Music changes.
So
lifestyle changes.
I think people out there have to have a little bit of an open mind, right? You got to change with the times, and you got to if it was always.
But that is
an
iconic band though, Metallica.
Yeah, but if it was always the same, I think I would get bored of it.
Yeah.
Anything like where it's just an extension of the same thing over years.
Well, you're absolutely right. I mean, if you take a look, they no longer wear a hairdo that's like 8 inches high.
No.
With a ton of hairspray.
No.
With lipstick and mascara. With tights. Like, come on now.
You're like even rappers, man.
Yeah.
Rappers, they change all the time. They change their music and how their beats and their hooks and their words.
And they're wearing suits now and all that stuff.
I mean, you always see those videos with the big things, shaking around and stuff. But that's about it.
Are you talking about the trunks?
The trunks. That's right. All right. Joint applications. Finally, a joint application is someone who applies for shared credit on a mortgage application. It does not refer to somebody whose signature is required by the creditor as a condition for granting the credit requested. So we all know that. We can't, as a lender, go out there and say, bring somebody else on so you can get the loan. They have to consider doing it on their own terms.
Oh, so you can't mention it.
No, we can't mention it. So a creditor may not require the signature of an applicant's spouse or another person other than a joint applicant on any credit instrument if the applicant qualifies under the credit standard of creditworthiness for the amount and terms of the credit requested. So it's just important to understand you have options out there, and when you talk about what does a spouse need to sign on, especially with a mortgage instrument, the mortgage instrument, is a problem because people don't think that they have to sign off on it, but they have to sign off a quick claim deed.
What is that?
Basically, when you go to title, you have to sign a quick claim deed.
So, because this is a community property estate.
That's exactly right.
Go ahead.
You took the words out of my mouth. It's a community property state, which is Nevada. So you have to go down there and you have to sign. And once you sign, then that's releasing the spouse that you're with from being anything a part of that property and anything part of title. So we had a client recently, a mutual client, that was very scared on doing that. And the reason why she was scared is she's still married.
Yeah.
She says, well, I don't want anybody to know anything about what I'm doing. So, that's her decision.
Yeah.
But what is my options? Do I have to still be on that? Does that person have the ability to take my home from me? And that's not the truth. You have to, so long as they sign that quick claim deed when you're at title, you obviously have to notify them at some point.
And it's how you invest in title as well.
Exactly.
Also, I do want to mention is if you went conventional, you would have that option too.
Only
as well.
conventional.
Yeah.
FHA and VA. Now, you could always get a quick claim deed.
Yeah.
But a community property state, you're also accounting for their debt and other things. That could affect you. So conventional is probably the best route for that because you only have to worry about your own debt.
Yes.
You don't have to pull the spouse's credit and find out if there's any credit cards or car payments or collections that's being collected or student loans that you don't know about.
Now, let me get into the real estate side. So let's say if you did that, next thing you know, you're back with your spouse. You guys have the same account. And you're taking that money from that account and you're making that payment to that mortgage company. Something happens, you guys split up. Now, what happened is now there's a chain link that's tied to that property.
Absolutely.
Now, that spouse can say, hey, you know what? Because we had the same account, I've been making payments. Now that can open up to litigation to actually go after that property. Now, understand that I'm not an attorney, okay? But from what I've learned through the process and what I've seen, these things can happen. So it's very important that you speak to an asset protection attorney.
Absolutely. So a creditor through a mortgage instrument may not require an applicant who is creditworthy to provide a cosigner if the creditor applies for the requirement without regard to sex, marital status, or any other prohibited basis. It's very important to understand that you can purchase your own home and your spouse, even though you're married, does not have to be on there, and you can sign a quick claim deed to get him or her off of that situation, and that's big. Because
so what happens if one spouse defaults on the loan? Is the other spouse responsible?
No, they're not responsible.
Perfect.
That's what you want.
Yeah.
If you want to do something on your own, you can.
Yeah.
Just because you're in a community property state, that doesn't mean you have to be tied. Again, FHA and VA, absolutely your debt's going to be attached to you if you're getting financing. But if it's conventional, nope.
Good to go.
You're good to go. Also, home values rise for the 48th straight month. 48 straight months, home appreciation has been going on. July marked the 48th straight month with rising home values. July's level represented a 5% year-over-year increase. It was still 4.7% below the April 2007 peak. So we haven't hit 2007, but man, we are right there.
Right around the corner.
It is so close. And that's why we talk about with these peaks and all these things going on, a lot of people are, when they bought a home or when that gravy train has maybe passed for a lot of people, because is there homes out there, Chuck, right now you can buy for $150, $140?
It's going to be very tough if you want an older home, but we still can make it happen. There's not that much to choose from, but you still have the opportunity to get into a home.
You go back to 2009, how much home can you buy at 140, 150, or 2010?
Oh, man, there were over 18,000 properties to
all
choose
at that
from.
price point.
You know what's crazy? During that time period, it was so hard to get a buyer to buy a property because they were under the impression that the market is completely down and we want to see what happens. But 2010, 2011 came around and all these hedge funds started buying. Now they were bought out of the market.
Yeah, a lot of underwater properties, too, that
That's
you could have
right.
got for a short sale. Also, Portland experienced the greatest appreciation in July. We talked about Portland earlier in our broadcast.
Yeah.
The rental side of the housing world, rents were up on a national basis by 2% over the past year. Again, one of the things that has to happen, I think, for this to keep continuing, where you have consistent months, consecutive, 48 straight months, especially for this,
Yeah.
you have to have labor. You have to have jobs lined up. You know, if you don't have jobs increasing or still there, who's going to be buying these properties
You know what? You make a good point.
or
because
renting these properties?
You make a good point because there's another article that I was reading. It was a article from an economist from Trulia, and he specified the top 10 places, and Las Vegas was actually one of them. And one of the things that he mentioned was job growth. Here in Nevada, increased by 4.8% in 2016.
That's big.
The national was only at 2%.
Why are we increasing so much better than others? Give me the example. Give me understand that I know why to a point, but what do you think it is?
Well, because if we take a look at the data, okay, 42 million people are visiting Las Vegas each year, okay? Not only that, our primary sector is hospitality and the service sector. We know hospitality and the service sector is the highest growth right now for GDP and also job growth. So what does that mean? So all the people that are working in the hospitality industry, you know, from valet, management, restaurants, they're coming out here, they're buying properties because the dollar is so cheap to borrow.
So if you're an average consumer out there and you're listening to this and you're going, so what does that mean? Why does it make a difference? It's 48 straight months. First off, that doesn't really happen. You don't have 48 straight months of appreciation going on where people are record numbers purchasing homes. And we're getting to that peak again where you in markets and especially in real estate, you see an up and down trend. So for it to be this long for this period, it's probably contributing to you got inflation.
Yep.
I mean, not inflation, but the printing of money. And you also have the idea that when you have a market that's stagnant, where the rates haven't gone up any direction really in the last few years, you're going to have a consistency of people buying because it's pushing people to buy.
Yeah.
And some of those out there, I'm not saying that you're smarter or not, people that are smart are looking at this and going, cheap money at 3.5%. I just locked somebody in the other day at 3.5% FHA loan.
That's a great deal.
I mean, think about that. Anybody that has rates below 4, that's like phenomenal. And it's been like that for how many years? Like at least probably 2-3 years.
No, longer than that.
I mean, at least. So, I mean, since we've been doing this show, I mean, so the thing is this. If you're trying to buy a home, it's something to look at because guess what? If it starts to go the other direction, then we're going to start to see probably more problems because that means either the labor's down, the demand is down, or guess what? They raised interest rates because guess what? If they raise rates, I think it's really going to start to hurt the housing market tremendously.
Well, it's going to hurt everybody.
It's going to hurt everybody. But this housing market that we see with all these great numbers, it's really there because of all the things that the government and the Fed has been doing with printing money, keeping rates low, and keeping the consistency. And you know, we're going to see a lot of changes going on, but I think, you know, I'm going to continue.
And it's coming fast.
Yeah, we're going to continue to see these appreciations. Dan French from the Market Snapshot. We'll be right back. We're going to talk to Chuck more about the housing market, and I'm going to talk about interest rates and possible rate hike. We'll be right back.
Here's what happened last hour on the Market Snapshot.
We always say, is it a good time to buy? You know, that's your personal decision.
Yeah.
You know, buying is a very, it's like a marriage. It's a long-term investment. But at the same time, there's a lot of incentives. If I'm going to buy or versus rent, I'm going to buy every time.
There is no middle ground in today's housing market.
We started seeing a climb.
Sales of existing homes rose sharply.
So the homes that have been selling are at a higher price.
Let's begin.
All right, in 3, 2, 1.
It's time to cut through the clutter.
Refinancing your home loan.
This is your source for the latest real estate and home financing news. You can actually use.
My prediction is that most predictions will be wrong.
It's the Market Snapshot.
Going live.
And now, here's your host, Dan French.
And welcome back to the Market Snapshot. It is Dan French from Nova Home Loans, your go-to mortgage specialist here in Las Vegas. I'm in studio as always every Sunday from 11 to 1 p.m. right here on News Talk Radio KDWN with Chakits ITZ Krulsawat.
Yeah.
And he is from Simply Vegas. And Chakits, what you got planned today, man? You got anything good?
I'm probably going to go to the gym after this.
You're going to go to the gym?
Yes.
Is it because I made a comment about cheeseburgers?
Oh, no.
You sure?
No, I got to work on my health, you know?
Okay, I just want to make sure because, I mean, looking at us both, we gained a little bit of pounds here a little bit, right?
No, man. That's just my belly.
Come on, Chuck. Yeah, that's just your belly. As always, you can find us on danfrenchloans.com, danfrenchloans.com, and you can also...
Why are you standing up?
Listen, I'm talking here. Find us on our podcast, iTunes podcast, The Market Snapshot. Go there and subscribe. And you can also download our app, KDWN app. It's our phone app. You can stream live. We've made all the progress with all these ways to get a hold of us or to watch us or to follow us or stream with us. There's really no excuse out there, Chuck, for anybody not to listen to us, right?
That's right.
I knew it. So we put it all together. Talked a lot about what's going on in the housing market. Talked a lot about what some of the changes we got going on, the appreciation. Jumping over, let's talk about what we had the hottest housing market going on for August. Where do you think that's at?
Well, I think we're going to keep going until the election, and we'll see.
What do you mean? You got to give me a place. Where do you think that's at?
Here's the thing. If we QE4, we're going to be good for another couple more years.
Listen what I'm saying.
Yeah.
Where is the hottest housing market located at?
Oh, right now.
Right now.
Here in Las Vegas.
Here in Las Vegas. No. It's not in Las Vegas.
Where is it?
It's in California. Man, you just were all over that one. I don't know what was going on over there.
You know what? I don't even know what to say. I'm just going to drop the mic. You just threw me off. Like, I don't know if that, what kind of question was that? That was
because
such a broad question.
Californians right now have the hottest market. And right now they're like 11 out of the top 20 has a hot market right now, but yet they're the most unaffordable place to live. So I guess they don't care that the destination of being there with the taxes and all the unaffordability that goes on in California. I don't see how that works. I mean, I don't see how they could have the top market and people still thrive there. I mean, they don't care. I guess they're going to pay the money, right?
I guess so.
You know how many Californians I have?
if you got the money, then why not?
Do you know how many Californians I have come here because of tax reasons? Not just for housing.
Yeah.
We're talking corporate or business tax return or tax reasons and incentives as well. So I just think that Californians, there's still a destination, but it's crazy to me because I thought they would be like on the last part of it. Mm-hmm. And, one thing about California is, guess what? They buy a lot of second homes here, too. Like Californians, they come here and they want to buy second or investment homes.
For tax purposes?
Not just for tax purposes, but because it's so cheap.
Yeah.
It's like, I'm going to live in California. Sometimes they station their jobs here in Nevada because of tax reasons, but they buy a home in California or do something. I've seen that happen. But the idea is that California is still desired. And I think it's always going to be desired no matter what cost, no matter what affordability goes on. I think Vegas is starting to increase the desirable, stigma that it has. But I think still we're not on that top 20 from what I'm looking at. I mean,
here's the thing. You're from California.
Yeah.
Why did you move out here?
Well, I moved out here for many reasons, but it wasn't. Listen, when I was a kid, and I call myself a kid, I was going to college at the time. I moved out after college because I just wanted to try something new. It wasn't because something was alluring me like taxes and things like that. But as I stayed here, I started to understand the big differences between states. Now, California is always going to have a special heart or place in my heart, but I can tell you that Nevada has a better living environment and is a lot more affordable than California. And that's why I stay here. One of the reasons, because let me tell you, I mean, the weather there it's really good. I mean, but with you have so many people living there, there's so many taxes and there's so many things that is not run as well as Nevada. I think, you got to stick and say, hey, where's the best place to kind of grow? And I think Vegas is it. So what do you think?
Well, probably because money's cheap. I mean, here's the thing. Vegas is like one of those places where, I come from Hawaii. And the reason why I came out here because everything is a lot cheaper. It's a lot easier to get a job. It's not like you got to know somebody to get a management position at like Target or something.
In Vegas?
No, I'm talking about, in Hawaii.
Yeah.
I mean, it was just so hard out there. And I realized here it's so much easier.
I think there's good and bad to that. You don't want to make it too hard, but yet you don't want to just get a job.
I'm just saying you have a better quality life here and you have more opportunities here versus out in Hawaii.
The only thing I would change about Vegas is the fact that whole thing of you better know somebody to get somewhere. That's somewhat true here. I mean, you could have a degree and you would still, if you know somebody that has maybe less, you got to go with the right person for the job. I say that for every time, right? But if you have somebody that you have a friend or somebody that's a family member and you're just trying to pull them in, you see that quite a bit more here than you do anywhere else. You know, you could have a relationship for life if you meet the right person and then you keep the same incentives going. It's almost like, you know, give and take. I mean, this city was built on hospitality. Let's not change that. Yeah. So you got to realize that. And I think that whole aura, the culture of this city still has that somewhat as far as knowing somebody or going that route. You know what I mean? So also Yellen hints about rate hike. You know, they talk about this all the time. Rate hikes are going to not occur this year. I'm going to come out and say that. What do you think?
Well, I told you, I think they're probably going to prop it up to about a quarter point. And the reason why they want to do that, so that way when they do print out QE4, that's going to give them enough wiggle room to drop it back down to 0.
But they can't raise rates, though. I mean, they're going to raise.
They can raise rates. Obviously, they rose at a quarter of a point.
But they don't want to because they know that the economic collapse will happen.
Well, I think they're backed up to a corner, and they're going to have to at least raise the rates, at least for a quarter of a point or an eighth of a point by the end of the year.
Right.
But I don't think it's going to affect the economy that bad.
Well, let me say this. If they were going to raise rates, they would have already done it. You know, you can't come out and keep saying something over and over and over and over again, and then you're crying wolf. I mean, it's more of now it's like, why even bring it up? Because it's almost like getting to the point where I bring it up, and the reason why I'm bringing it to you as a consumer is because it will directly affect you in numerous ways. It could affect you buying a home. It could affect you in the inflation process, especially if they raise the Fed's fund rate. So there's all these things that would affect you directly to you as a consumer. And, you know, it's one of those things to kind of keep an eye on, because if you're a person that's busy working 2 or 3 jobs, maybe you get the information on the economic news from this radio show. Well, guess what? You're going to consistently get the up-to-date information. And this is what happened on Friday. So all this good information that you're getting, use it to your knowledge. Also, multifamily production index takes a second quarter dip. You deal with a lot of multifamily, right?
Yes.
Okay. Why do you think it's taking a dip?
Because the prices are too high per door, and a lot of developers that are coming out that's borrowing cheap money, and they're putting these people in place because a lot of people do want to rent. But if you take a look at the rents, I mean, they're like $1,200 per unit.
So the rental has gone up. It said it's tripled.
Correct.
From what it was before. And now that the rents are there, you're paying basically triple the amount of what. Let me say this. If you're somebody that's a multi-family renter, traditionally there's a certain type of people that like that. Yeah. You know, it's almost like getting into an apartment, but it's not, right? Yeah. It's similar to it, right? Because you're all connected.
Correct.
Now, if you're in a position and you say, well, I'm doing this because it's maybe sometimes cheaper than it is to rent an apartment, right? Yeah. Okay. If it's tripled, where's the incentive to stay there?
But hey, let me retract and go back to answer your question that you talked about. Where are we going with the multi-sector? The reason why, obviously, you know, rates are actually increasing on multi for the rental sector. And if you take a look, the reason why it's slowed down, because that's where we have to watch the rental market. And the rental market is going to dictate what the prices are going to be for the multi-sector. So what's happening is on the rent. Have they increased at that point? Yes, they have, but you have to take a look. And the reason why this is important is because multifamily, the price is based upon what the income and the cash flow is from the property. You can't comp out a multifamily like a single-family residence. It's really based upon the income. It's like running a business. It's what the cap rate is. Do you see what I'm saying?
Absolutely.
So what happened is now that the multi-sector is priced so high because they're making so good money, what's happening is investors are starting to slow down to buy these multifamilies because they're paying way too much per door. And that's why if we take a look at duplexes, triplexes, and fourplexes and up, per door, they're running about $50,000 per door. I've even seen them high as $100,000 per door. At that point, the numbers are not making sense for the investor.
$400,000 on a fourplex. Because anything, is that what you're saying?
Per door is about $50,000 per door, so it's $200,000. So you have to imagine.
But you're saying you've seen some as high as $100,000
per door.
Wow.
So if we take a look at this and let's do the math, if you buy a fourplex for $200,000 cash and you're only making what $2,400 a month, your return on that is really not that high. Your cap rate is probably only about 8 to 10% cash on cash return.
And it's harder to find people to rent them once you do buy it, right? Because they don't want to rent a property or a room really or a section of that fourplex for triple what they were probably paying 2 or 3 years ago.
Now, it also depends on the location as well. I mean, a lot of fourplexes out here, to me, they're not in a very desirable spot. And what I mean by that is it's classified as A, B, C, and D class, and majority of them are in the C or the D class.
Oh.
Anything in the A and B class, you're going to get more of a higher rent, and the value is there.
Right.
But it's in the better part of towns. It's more of a newer development. And that's what we're starting to see where...
Kind of like the grading system.
Exactly. So that's why it's very important. Even when we even look at single-family residence, we have to take a look at the rental market too as well, because the rental market is going to play a big factor on should I buy or should I rent.
Absolutely. It's hand in hand, really.
Exactly. Because here's the thing. If rents are going to be very cheap than the mortgage, then what's going to happen? People are going to probably decide to go ahead and rent instead. But when the rents increase because they know that investors are coming out here buying these properties, putting it on the market because they know they can get the rents, what's going to happen is as rents go up, now they realize the mortgage is cheaper. Now I would rather buy. So that's where you have to kind of weigh your pros and cons, and there's like a barometer between, and it shifts left and right, back and forth as far as should I rent or should I buy. And that's what we have to take a look at. And I do want to mention that it's so important. It's just not to only look at single-family residence. We have to look on the rental side sector too as well.
Again, this is Dan French with the Market Snapshot here every Sunday from 11 to 1 p.m. on KDWN News Talk Radio. We're talking over here also about the news and events going on. One of the news, the other thing that I want to bring up was that TRID. So TRID has significantly increased appraisal turn times. I don't know if you've been dealing with this, Chuck, but I'll tell you, a lot of my appraisals have now been extended. And I think it's because of all these regulations that's come out. And you look at all these people out here looking at me going, why is the appraisals taking, 7-10 days? We have an appraisal management company. And what that does is it extremely, extremely helps with turn times. Now, when you come into like VA turn times on getting an appraisal, that's totally up to them. They have their own restrictions, their own guidelines. It could take 2 or 3 weeks. They don't care. So that's the thing. We don't control that as a lender. Nova Home Loans, the mortgage, not the mortgage, but the appraisal management company cannot control that. We control internally, though, anything conventional, FHA, or VA. Now, what happens is that when you have regulations or extended regulations, we have now turn times that is extended out to clients that normally, including the relationships that I have, they're not used to waiting 7 to 10 days. I've seen that recently. Have you seen the same thing?
Yeah, I have. Trust me, we'll work together. But with these new restrictions, aren't they aware, and shouldn't they put in factor that a consumer, once they go under contract and they put a certain term, let's say 35 or 45 days to close, that if we can't close on time and the seller does not agree to extend it, the buyer can literally lose their earnest money deposit. And now they're putting that buyer into jeopardy.
Let's say this. There is that fine line. Absolutely. I agree with you. Now, if you're an appraiser, though, look at it from their standpoint.
Yeah.
What is their job? What is their description? And are they going to put themselves at risk? So if they're just going to keep doing the same thing and not following the new restrictions and guidelines.
So are you saying that we're selling a lot of homes, they don't have the time to go out there?
What I'm saying is that with the new added restrictions, it's now delaying them because they all know that there's 30 days, but they're all feel probably a panic because now they're put in jeopardy of meeting or not meeting the close of escrow. And now they're having a problem getting it back in that 3 to 5 day window like we did. Now it's 7 to 10 days. So they're feeling the heat from everywhere, from TRID, from all these things that's going on. And I've seen traditionally right now, I have seen over probably the last 2 or 3 months, consistency of appraisals coming back longer. And
I don't see how that justifies it. I mean, how long does it really take to appraise a property because you're doing it based upon subdivision, quarter of a mile, and you're comping everything out?
Well, I don't know if it's about the time to appraise the property. I think it's about when they bring the appraisal back, making sure that they're making the right adjustments so they don't get audited or they don't get looked at.
So that means they need the systems in place to get this turnaround time a lot faster.
Here's what I'm going to say.
It is not fair to the consumer.
Here's what I'm going to say. If you're a person out there that's a real estate agent or somebody that's looking to purchase a home, there's nothing wrong with getting a 45-day close of escrow. All right. I understand everybody that's a seller is like, I want to get out of this house as quick as possible. I'm going to accept the offer that's best, but also has the shortest window and the shortest turn period.
Yeah.
But I can tell you this. Sometimes that doesn't help you. Sometimes that doesn't make sense. You might need to say, listen, let's all write our contracts for 45 days. If we close quicker, as a lender, I'm not going to try to extend it to 45 days. But you know what? If I have a 2-week process now where the VA appraiser or 3-week because they can't get it back, or we had an issue where you go to Pahrump and then the appraiser doesn't want it. We had a property in Pahrump and then the appraiser says they can't find comps on that property, so they had to assign it to somebody else. You need things like that happen in the process, so that way you have the time period and the adjustments that might be needed, right?
That's
so
right.
why not write for 45 days or less? There's nothing wrong with that. If we close in 32 days, we close in 32 days. If we close in 28, we close in 28. But you got to adjust with the times, and we are being more governed, more restrictive than anybody out there, including for appraisers and for lenders. So you got to realize that we're trying to, if you don't see progress once you get into a contract, if you don't see progress, that's a big red flag. Meaning, if you're calling and getting the same thing, but if you have a lender that's proactive, I give out Tuesday status call updates every Tuesday to where the file's at, where things are at. I mean, I'm like a pit bull on that. So I come in and I tell everybody, but you know what? Sometimes I tell people, you know what, Chuck? There's no news, but you know what? We're still trying to move it forward, and I'm still waiting on the same thing. And I had a conversation with the appraiser. The appraiser says he should have it back at such and such day. You're still getting information that's needed, where I think a lot of people in my business make it harder than what it is, first off, to getting financing, but they also don't update their clients well. What do you think?
I would have to agree.
Yeah, I mean, the thing is I'm updating people all the time. So it's important to understand that the appraisal process right now, you have to have a little bit of leniency. Also, can you believe this? That the Fed actually now has a Facebook account, and you can go on there and you can like their Facebook information and all the posts that they put on there. You're going to do that right after the show, right?
Well, I actually have all their Twitter feeds, because I believe that there's a total of 12.7 private sectors for the feds.
Who's paying for all those ads? Is it taxpayers?
Of course.
So they got 13,000 likes right when they did it, but I guarantee somebody's paying for those ads. Who's paying for them?
You.
Chuck? Of course. Also, I wanted to tell you, ransomware is now affecting home appliances that are connected to the internet. So with all this communication that goes on, it's starting to get affected. And then also large banks are starting to see this, and they're collaborating to share information on cyber threats with all these things. I mean, if you have problems internally, just with your appliances, somebody's going to try to tap into these banks. And, they've had hacks, and they're trying to sharpen cyber defense through like war games, if you want to call it. The group is part of a broader industry effort, but focuses on threats specific to big organizations. The fear is that Securities and Exchange Commission's consolidated an audit trail plan that lacks necessary cybersecurity. So with all these things going on with cyber, the cybersecurity and people trying to hack, that's a big deal right now.
Yeah.
And banks and non-depository mortgage banks are really where the money's at. And, imagine if somebody cyber hacked a mortgage company. What if they got all the information that a mortgage company has, the credit, where people live? They can take all that information and start using it, kind of like what they did at Target. Remember at Target when they did that? They could imagine if they did it with a mortgage company.
Well, hopefully they pay off our loans.
They ain't going to do that. They're going to tap into everybody's Social Security, pull money out of their accounts. They're going to get all their information about where they live. I mean, a mortgage company has a lot. I mean, there is a lot of information that we gather. Imagine if somebody tapped into that instead of just tapping into just credit card numbers.
I'm going to go pull out my money right now.
You better pull out your money. All right. Also, let's talk about Janet Yellen. We talked about the Federal Reserve. With these whole rate hikes and stuff, I want to kind of put this to bed. You're saying that they're not going to raise rates at all this year?
No, I'm saying that they may raise it 1/8 of a point or of 1/4 of a point. And only the reason why is because their back is towards the corner. They've been talking about they're going to raise it, and they haven't raised it. But it's going to come to a point where you're talking so much smack, you got to do something.
Back it up.
Back it up.
With that big stick.
Even though if it's 1/8 of a point, it may slightly affect the economy a little bit. But I think that's to help them out for the election.
Last thing I want to talk about here today is CFPB acknowledges workplace discrimination. That's pretty big. After years of ignoring public charges of workplace discrimination, the Consumer Financial Protection Bureau made a rare admission that it discriminated against one of its own staff. According to Daily Caller, the CFPB Office of Civil Rights and Office Equal Opportunity and Fairness sent a notice to the U.S. Consumer Coalition. So how do you do that? I mean, you're out there trying to pitch to everybody out there that you're there to protect them.
Yeah.
To protect their rights, to protect what they're doing, and then they're doing it internally. See, that's what I always say. Anybody that's out there that has any type of power, it's always going to be abused. And I don't care what anybody says. Anybody out there that has any type of power will use their power and at some point will abuse it and get caught for it, because when you have too much, it's too much. I think the CFPB has too much power now. I mean, they're looking for reasons to find people.
Well, you can't have one rotten egg, spoil the whole bunch.
No, but here's what I'm saying.
Now.
This happened for a period of time.
Yeah.
If I'm going to hire somebody within the CFPB, everybody, and I'm not saying that it's bulletproof, but everybody's going to kind of understand what we represent. It's the culture of what you're doing.
Yeah. And the penalties should be a lot higher.
Exactly. So, additionally, the Bureau violated looks like Title VII of the Civil Rights Act of 1964 when it retaliated against the employee because the employee spoke out against the discrimination. So they came out and said, "I'm being discriminated against."
Yep.
And now, I guess they're going. They're being looked at right now as far as internally that they could have some issues and actually could get people either fired or something's going to happen.
Yeah.
So. That's amazing to me because I think the CFPB, everybody in our business and industry, including you, they look at them as being the big entity that everybody has to look towards, especially if there's going to be some type of, some disciplinary action. They're the ones that start it. They're the ones that govern it, and they're the ones that hold everybody accountable, but yet they're doing the same thing, it seems like. So it just goes to show, man, that you can only do so much. You got to have that culture of your business or whoever you are to make those changes. But I thought that was ironic. What do you think?
That's very interesting.
Yeah, it's very interesting. So let's talk about the housing market. Do you have anything on the housing market right now?
Are you ready for this?
I'm ready for the housing market.
You want to know where the hottest spot right now is?
Where's that hot spot?
Guess. Where's the hot spot?
I would say it's Southern Highlands.
Nope.
Oh.
One more time.
Summerlin?
California. We talked about it.
Why are you talking about California?
Let's break right into it. If we take a look at the overall closings last week, we closed about 524 properties. If we take a look at the median for a 3-bedroom, 1,865 square feet, the average list price was at $243,500. Guess where the median price is today, Dan?
$249.
No, $239. So we've increased $4,000 from $235 to $239. The average price per square foot, $126 a square foot. The amazing thing in the days on the market is 22 days. The average was at that point was at 17 days, so we increased by 4 days. I don't know if the market is slowing down or not, but I can show you that the prices are actually increasing, believe it or not, even though that school is around the corner. But we'll see here in the next 1 to 2 months how that's going to affect the marketplace. So keep that in mind. But let's take a look for single-family residents. The overall market right now, we actually have a total of 8,160 properties to choose from. 91% of those are actually traditional sales, 6% are short sales, and 3% are actually bank-owned properties.
Bank-owned.
But remember, the average days on the market for a short sale is about 120
Hey, talk
days.
about short sales. We got underwater numbers recently. 19.5%. That's still pretty high. Isn't it? I mean, why are these people, if it's 19, I'm not saying it's as high as it was. But,
here's the thing, at 19.5%, but you have to understand, if it's only 6% of the market, there's only 503 homes that are currently listed as a short sale.
With all these appreciation going on, how are they still underwater? They must have bought, ridiculous numbers.
Well, exactly. Like, let me give you an example. In my neighborhood, homes are selling for $450. I bought it for $195. Right now, it's only worth $245. So you have to understand that these numbers that are probably coming out.
In your neighborhood, they're buying it at $450?
At that time, 450,000. Yeah,
wow.
450,000. So you just have to understand these numbers are probably calculated where people are just right on the fringe or not making those payments, or they're still underwater, probably like $5,000.
See, and then you look at it and you're like, wow, it's not the numbers that we had before. Obviously, it's still not peaked at where it was at. But still,
it's not going to peak.
It's not.
I think it was so overinflated. $450,000 for a home that's only 1,600 square. That's like almost $300 a square foot.
Imagine what you could buy like right now, or what you could have bought with what you're buying now in a new part of the area, or like a new home. You got these new homes out there that are like what, 350, 360. What were the new homes selling back then? I mean, was it like
a lot more,
500,000 or 600,000?
That's exactly right.
I mean, it's crazy.
Now, here's the other thing that you have to understand. Sometimes these consumers are thinking, what happens if I buy now and home prices will increase that high? I don't think it's going to increase that high. The reason why is because if we take a look at the valley, we live in this valley. It's about 30 miles from one end to another. We have so much land to build on. Home prices are not going to skyrocket like that anymore. It's not like California where it's nothing but landlocked. We go out to California, landlocked.
Yeah, we'll be right back. This is Dan French with the Market Snapshot. We got a last half hour. We're going to talk about the market here in Las Vegas. We're going to talk about interest rate trending. We have a lot of show left. We want to give some good information out there. We'll be right back.
Ready for even more content?
Yes, thank you.
Check out past shows online at danfrenchloans.com.
Yeah, now you're talking.
Stick around. The Market Snapshot continues next here on News Talk 720 KDWN.
Welcome back to the Market Snapshot. It is Dan French from Nova Home Loans, your go-to mortgage specialist here in Las Vegas. In studio with Chakits, ITZ Krulsawat from Simply Vegas. How you feeling today, Chakits?
I'm feeling good.
As always, you could stream live with us on KDWN app. You can go there. You can go to the website and stream live there. You can also go and download our podcast, or you can subscribe to our podcast. It's the Market Snapshot. Also, go to my website, Dan French Loans, LOANS.com. Tell all your friends and family to jump on there. You're going to get a lot of past shows, a lot of good information, a lot of educational videos, a lot of things that went on, especially for me. I have closings on there. That's past closings. You can also sign up. We have a G card sign up on there on the front page. You know, and I talked in the beginning of the show, if you want to go and jump on there and you also want to try to get free credit services to anybody out there, 6682. You can text the number 6682 to 55,000, or you could jump on there, start the application process. You can jump on to Dan French Loans. It has an indication there for you to start there. And what this does is it also gives you a tool where you can look at any property through IDX, which is really the same thing that anybody would get if they got a realtor involved and put them on the MLS search. So this is all good information. One last thing. We have people in office standing by. You can call us in office, 702-281-6682, 702-281-6682. You can call there, and you can get started on the process of getting started on home financing or getting information through anything we just talked about.
They're standing around and waiting for the calls?
Well, I got people sitting there, and I mean, they got the
you got people?
Hey, I got peoples.
Oh, you got peoples?
I got connections.
Moving on to the housing market. We actually have a total of 8,160 properties currently available on the market. 91% of them are actually private sales, 6% are short sales, 3% are bank-owned properties. What I find very fascinating is that 9% increase of inventory for traditional sales.
Right.
So a lot more properties are actually coming up on the market right now. Now, if we take a look at the closing ratios, last week we actually closed 21% cash buyers, 40% are conventional buyers, and 27% are FHA and VA at 10%. So what this means to you is that if you are a VA buyer or an FHA buyer, you still have a chance to beat out a cash buyer in today's market. So do not be misled.
Right.
Now, let's move on to townhomes. The median price right now for a townhome, believe it or not, is $150,000. That's pretty pricey for a townhome.
Yeah, it is. It's pretty pricey.
The good news is that here's the thing. I definitely would love to buy a townhome versus a condo, just due to the fact that you have more square footage.
Yeah.
Not only that, you have a garage attached. And what the difference is from a condo, you're only sitting at about 1,000 square feet right now. And on a townhome, you can get about 1,400, and that's a 3-bedroom. So if you can't get the single-family residence detached that you're looking for, the next best thing is a townhome, and you can possibly get it in the location that you are desiring. But obviously, it's a townhome, but that's the next best thing.
Right.
But remember, you're probably not going to live there for the rest of your life. Am I correct?
No, it's probably not going to happen. I mean, 5 to 7 years average person. You know, I just want to throw that number out there again. There's 2 numbers. Sorry, real quick, Chuck.
Yeah.
781-6682, 781-6682. Also, that's in office. You can also call me at my direct office number, 702-216-3907. That right there will get you a number, 702-216-3907. If you leave a message, again, we can start the process on getting all this going. So let's talk about townhomes. Townhomes and condos, there's a big difference, right? Condos themselves are not 100% owned. It's 88% owned, correct?
To a certain extent,
yeah.
yes.
And so when you see that and it says a unit number, just stay away from them if you're going FHA or VA. You're not going to – there's like 5% of properties that are approved through VA or FHA getting a condo. So we just want to throw that out there because a lot of people, especially in this market, when we talk about being bought out of a market and you're only approved for 140 to 160, well, guess what? That's what you're probably going to start looking at. You're going to look at a blend of condos. You're going to look at properties that are not as, that maybe not at the, the average median price point at 239. You're looking at something significantly lower, so you have to compensate. We talk about this all the time, Chuck, where if you're buying a condo versus a townhome, and you let me know about this, when you're out there looking for a property, you can't have all those things that's in place and say, I'm only going to accept this and that's it. You have to have some leniency, right?
That's correct. Now, also, when you're going out and you're looking, and you can't tell the difference if it's a townhome or a condo or if you can get finance, the agent that you're working with, if they've been in the business for some time, they should be able to identify it immediately by looking at the county records, right, to see if it will actually finance. Now, if the agent doesn't know that, that's probably an agent I wouldn't want to work with.
Well, the thing is this, man. It's like this. Everybody knows they have a desired place.
Yeah.
And we're talking about townhomes and condos because, listen, I get that question a lot during the week, and we've talked about it a lot on previous shows because when you have a market that has appreciated as much as we have, you can't always buy what you want, and you can't always get the location that you want. I understand you want the location that Summerlin, Green Valley. Sometimes you have to sacrifice to get where you need to be. And you know what? Life is a stepping stone.
Correct.
Sometimes you start off lower and you increase. Now, I'm not saying go buy a condo or a townhome in an area where there's a lot of crime. If you have a family, obviously that's something you want to stay away from. But if you find something that has majority of the things you like, you can't just say, I don't like that. I understand you're buying a property, but have a little bit of leniency and understanding that in this market and where things are at, you have to have the ability to adapt.
Now, I do want to mention that because you're going to be living in a property for anywhere from 5 to 7 years. Should you happen to buy a condo, understand that when the time comes around to sell the property, you are definitely going to minimize the demographics on the buying side. You're not going to have that many buyers out there submitting offers on your condo versus a townhome or a single-family residence.
Right.
So that's very important. Obviously, the more desirable is a single family, then it goes to a townhome, then it goes to a condo. So it's very important when you're making these decisions that you sit down with a professional that can explain these items to you based upon your situation and where you're looking to head in the near future.
Absolutely.
That's it? You're not gonna say that? You're not going to say nothing?
Oh, nothing.
Don't you want to know where the best place?
Where's the best place at, Chuck? Throw it out.
The hottest place right now?
Where's the hot spot?
You ready?
Yeah. Where are you going to lose your license? No, just like
California.
Just like.
I do want to mention that a lot of people are in the marketplace right now. A lot of people that I'm working with.
So you're saying where, though, is the best spot to buy?
Well, I'm not going to say where's the best spot to buy, but when I'm trying to explain to the listeners out there that, a lot of people are starting, they want to start off in Henderson or on the south side of town, the southwest, or even Summerlin. But what's happening right now is because the price has gone up pretty high at this point, what they're realizing is that I'm bought out of the market.
Yeah.
So where they are starting to move is out in Providence, out in the Northwest, because homes out there were built around 2006 and up. And what's happening is you're getting more bang for your buck.
Well, let me say something about 2006. So there's a lot of short sales still out there.
No, there's not that much.
There's not. Okay, so we had a short sale issue. We have an avid listener that we're trying to help out. We're not going to go under names, but you're stating, or there was stating that they did not want to contribute towards closing costs.
Yeah.
So why is that occurring now?
The reason why is because the bank understands that they can actually get what they're looking for because the market is hot. Not only that, I think that buyer was an FHA buyer, I think it was.
Yeah,
and
but
they still weren't paying for the closing costs.
But here's the thing. It's not about the buyer. It's more about were they doing it before, now why are they not doing it now?
Well, that's what I'm trying to get into. And the reason why is because the market is hot. Now, normally what happens is a couple years ago, if you were a conventional buyer, the banks would understand that you do have some money to pay your own closing costs, and they would always negotiate that.
Right.
But typically now, with an FHA buyer, it was a lot easier to squeeze through. But what I'm starting to see is a lot of these banks are coming back and saying no because they understand that the listing agent, once they have the set dollar amount and they understand the terms and the conditions, the agent will just throw it right back on the market and they will get what they're looking for. based upon a letter of approval from the bank. And the bank knows that at this time, they don't care. The market is hot, especially at the price point that you're buying at. Now, if the home was at $500,000 and you don't have that many buyers or so many bids on those type of deals, then you can possibly get away with closing costs. Not only that, it also depends on who's negotiating the deal. Depends who is the entity. Like the team that I'm working with, they're not executing. I told them to go back like 3 times. We don't have the money. But at the end of the day, I don't know if that verbiage was actually submitted. Because what happens is sometimes that listing agent doesn't care, and at that point, they'll just go ahead and throw it back on the market.
So let me say something real quick. You're saying
it's really case-by-case basis.
Yeah, but you're saying this, and this is what I'm getting from your conversation here, your quick topic is, if you don't put the verbiage in there, then that could be a problem with the realtor not doing their job.
Well, I don't want to say that, because what happens is when we submit an offer, we are requesting that we want closing costs to be paid for. Now, as far as internally on the back end, we don't have access to see what's going on the listing side.
Oh, I see what you're saying. So the listing agent might not put in there that they want closing costs paid by the seller. They're just trying to get the offer accepted.
Well, here's the thing. The negotiator will take a look at the contract, and they'll see that we are offering that, okay? So what happens is the negotiator will deal directly with the processor, with the listing side, and they may send us an email and say, hey, we spoke to them. We had verbal communication. They don't want to pay for the closing costs. Then we can go back and say, we'll type up an email, hey, we can't pay you closing costs. Then that could go back and forth, so many times. And
let me say this. I get a lot of people, and I'm going to say why, because I get a lot of people that are buying homes at $300,000 to $400,000. There's a lot of buyers out there now. I mean, there's some out there that need extra help. They get to have somebody that has been put on the loan, maybe add a co-buyer or somebody or a co-signer. But you also have those people, like I said, at the $150,000 to $200,000 range. And the reason why we're bringing this up is because that's where you might find that golden nugget deal where you can buy something maybe in a nicer location for a short sale.
Yeah. And it also depends. I mean, like right now, we landed a really nice deal for a client for $200,000. They got the grant program, and I was able to ask for closing costs. And the only thing that they're paying for is literally just the home inspection money and also the appraisal money. So it's really case-by-case basis. It depends which company that, you're dealing with. Also depends on the seller, how motivated the seller are.
Right.
It's really case-by-case basis. And, short sales are tough, but sometimes you can get a good deal just depending what the entity is and also what the purchase price is as well. Now, here's the thing. At the end of the day, we still got the deal done, but the buyer decided that they didn't want the deal. Now,
they backed out.
Okay. So it has nothing to do with...
Is there anything that comes in and affects the buyer if they back out?
On a short sale, no, because there's a clause in there where it states that the seller must get a letter of approval within a certain period of time. If not, then we can back out and get our earnest money.
And how often does that happen where they get that approval letter in a period of time? Or is it because let me give you an example. One person I'm working with is going through had a bankruptcy, and they were in a short sale contract, and then it's not going to be 2 years until I think it's the beginning of October.
Yeah.
And they just got into a short sale contract, which it normally takes about 3 months, right?
Yeah.
So if they don't get that approval from the bank in a period of time, they could technically back out of that deal as well.
Yeah,
right?
I mean, it just depends on the contract. Here's the thing. On the addendum on page 2, it specifies exactly when the listing agent must receive a letter of approval. Now, if you do 30 days, they'll probably never accept your letter. I mean, your offer, just due to the fact that the listing agent knows that they can't get that approval letter by then. In today's customary practices is about 90 days. So what happens is before we go out and look at properties, we explain through the consultation on how things work. But normally we will look at short sales, but they understand that the short sale offer that we put our offer on, this is just going to be a backup offer. If it gets accepted, we just tie this thing up in escrow. But we're still back out into the marketplace looking at bank-owned properties and also traditional sales, because we know we can close within 45 days of a fully executed contract. Now, should we happen to find something else, then what we'll do is go ahead and back out of the short sale and take that money and deploy it on the deal that we just got our offer accepted.
Right.
So it's kind of like putting one egg in the basket. But now, here's the thing. Here's the caveat on this thing. If I know from a consumer standpoint you only have $5,000 and you've already tied up $2,000 on a short sale, then at that point we don't want to be tying up too many short sales, because you don't have that leverage or that luxury to be putting that many offers and getting them accepted.
Let me say this. How can if you're an average consumer out there and you never bought a house, how is it that you can go out and make multiple offers on properties?
Because I'm good at what I do.
So here's the thing, though. Let's say they say, hey, I collect it or I want it. Mm-hmm. And then let's say that there was a property that they originally said I'm going to take, and then they found another property that they desired more.
Yeah.
and they're asking for an earnest money deposit, let's say they put their earnest money deposit down, and now they're like, hey, I want to back that earnest money out and put it on another property. Can you technically do that?
Yes, you can technically do that, but what happens is you're dragging my name through the sand or through the mud, and it's not a good thing to do, and that's where we disclose with that consumer up front. So we need to make sure that the short sale that you really like, we're going to move forward with this deal should happen. It actually gets accepted. Now, here's the thing. Once we put in the contract about 90 days before the letter of approval, around day 88, if we're not making headway at that point, we'll still leave that property into a short sale and let that one incubate. Now we're back out into the marketplace. If something gets accepted at that point, after the 90 days, I can cancel out with any further signatures from either party. And at that point, we can just take that money out and just deploy it in our new transaction and move forward. So that's part of the strategy, part of our strategy. The other thing is that when we go out and we look at properties, we literally write multiple offers. If we look at 10 properties and you like 10 properties, we're writing offers on all 10. The reason why I'm doing this is because I would rather have all 10 come back and accept it, and you just tell me which one you want. And it's the way that we write up the contract, and it's part of my strategy, especially at the price point that you're at, because I want to leverage you out, and I want to make sure that we have every single opportunity to get your offer accepted. We're wasting time by sitting around and submitting one offer and waiting, because remember, the average days on the market right now is 22 days.
Yeah,
imagine it takes 5 days just to get a response.
And that's pretty quick, right? I mean, it used to be like 50 days, right? Wasn't it at some point? Because I think the sellers were putting their properties out there for way more than what they really...
Well, before, and it dropped down to 17 days, and 17 days is actually pretty quick. And there's even 22 days, believe it or not.
And here's the other thing. We're going to talk about the appraisal thing real quick because I want to bring this up. 22 days on a market, too, just to bring that topic up, is actually good. And I'm going to tell you why. Because in our past, we've seen markets where it was appreciated so much, where sellers were trying to get so much money, and then when they would come in, almost all my deals at one point, there's a fine line where all of a sudden the market starts to go the other direction and starts to go down.
Yeah.
Well, people are listing their house, and that's where a good real estate agent comes in, listing their house for too much, and if the appraisal comes in less, then there's that negotiation part of it comes in where do we either lower the amount that we're purchasing it for and write an addendum, or does the buyer come in with the difference?
Now, talking about that, if we take a look at the data today, 10% of the homes every single week are actually getting a price reduction.
Yeah, see, and that's what I'm saying. That right there tells me that there's a lot of inconsistency with what people's projection or thought is on where this the market really is at.
Now, at the price point at 240 and below, what I'm starting to see is because there are still the mom and pop investors out here that are actually putting lipstick on the pig as far as flipping these homes. They now have to season their homes for a certain period of time to accept an FHA offer. We're going through this transition right now with this deal that we're looking at. We literally got to wait another 2 more months for us to get our offer reviewed because we have an FHA buyer.
Speaking of that, I want to tell you a quick story that happened with that. I had a buyer that went into a property. They purchased the property, went into it. They did an inspection.
Yeah.
And it's very important to find the right inspector, too. I'm not going to say names, but they went in there and they looked at this house. It looks like they took like some paint to cover up. Looks like it was mold or some type of water that was dripping. And
lipstick on a pig.
They just painted over it, and then once they got in there, guess what? Within 2 weeks, the water pipe broke.
Yeah.
And there was water all over, and they had to actually get it cleaned before they can get in there.
Now, talking about home inspectors, it is very important when you start picking these inspectors, make sure that they are licensed and bonded and find out exactly for how much.
Absolutely.
Also, the other thing I want to mention is, how are they providing the report to you? And number 2 is that when you're going through the inspection period time, the due diligence period, make sure that you are out there. And the reason why this is important, because if something comes up during that time period while you're there looking at the home, he can walk you through the house and explain to you what these systems are, how much it's going to cost you to replace it, because it's a lot better than, trying to look online, looking at pictures and somebody trying to tell you exactly how these things work, because I'm not mechanically
I want to say something
inclined
about that real quick.
Yeah.
We're going to jump over to interest rate trending because we're running short on time, but I want to say one thing about that. So you're a listing agent.
Yeah.
You go through a property. You have a pretty good idea about what's going on with the home?
Yes, and the reason why...
real quick, so a listing agent should have probably seen that and probably knew about that or did know about it, and then they still tried to sell the house.
Well, here's the thing. They have a fiduciary responsibility to disclose everything, and it's ethics. Okay, if there's something wrong with the property, and on the SRPD, which is a seller real property disclosure form, it's a form that the seller must identify all material facts that may affect the value of the property. Should the agent is aware of it, it is their duty and it's their obligation to let the
but some
seller
don't do
know.
it.
Well, here's the thing: if they don't know, then they just don't know.
I understand that.
Okay.
But if it's me and I'm a realtor and
It's the right thing to
I'm
do.
the seller on that property, I'm going to tell everybody about it.
Yeah. Now, here's the thing. When we go into a listing appointment, I had one where, the ceiling was, had some leaks inside the garage. And I explained to her, I said, look, if we have an offer accepted, if it's FHA, if it's any type of financing, the appraisal guy is going to take a look at this. These are going to be an issue. So we have to address these problems up front. And that's what we do as professionals. We are the professionals in our trade, and we have to disclose all this up front, and we don't want to tie up a deal for the deal to fall apart. We want to make sure that we button tight the transaction so that way once we put the property on the market, we're streamline the process between buyer and the seller.
All right, I'm going to jump over to mortgage interest rates and also applications and where they ended up this week. We talked a lot about the housing market. I'm sure Chuck's got more to talk about, but I want to throw this in there before we leave. We got about 7 minutes. The mortgage application volume fell 2.1% from a previous week. Volume, however, was 28% higher than the same week a year ago. So that's still good. I mean, applications to refinance a home did not fall for the week, but it didn't fall very much. It was down 3%. The refinance share of mortgage activity now stands at 62.6%, a slight decrease for the week. While refinance applications remain elevated due to lower rates, closed refinances actually fell in July and are down from a year ago. So refinances from a year ago are down. Mortgage applications to purchase a home, far less rate sensitive week to week, fell 0.3% and are at 7.7% higher. So even though we're falling a little bit, that doesn't mean overall we're doing bad if you compare it to last year. And you want to do this on a year-over-year basis to a point. Obviously, trends with rate, with home prices, with applications, things like that, you want to stay in consistency with. You also have mortgage bond prices finished the week near unchanged, holding rates steady. New home sales printed, which is a very small margin of what we really look at, I think, as the economic terms for new home sales. It's not a big part of it. It's at 654,000 versus the expected 580. So that was actually good news. That was better than expected. You also have, according to FA Housing Price Index, housing prices rose at a 5.6 annual rate in previous months. So we're up 5.6%. I think here we're up closer to like 7%, right? So you look at that. Janet Yellen spoke on Friday. She told us that, look, the Fed is looking at raising rates, but it's just not going to happen. It's a consistency that's going on. With all that said, we did see a little bit better as far as the stock market on Friday, but Friday also showed unchanged. So there was not really a big change in interest rate, and everybody out there is like, well, rates are upticking. They are, but they're not upticking at the levels where you should be alarmed, because you're going to see this volatility in this cycle of up and down interest rate trading going consistently on, which is, rates are attached to a bond. That's what the thing is that people don't understand that it's going on where changes are going on a day-by-day basis. And it's sometimes 3 or 4 times a day it's changing. And when it changes, it's usually because it's a bond that's gone up or down. Usually if it's inverse. If bonds go up, typically rates go down, right? And if bond prices go down, the yield on them goes up. And that's what people got to understand, is that it's an inverse relationship. But you got to stay in tune with where rates – I think people are really staying in tune with rates and how pricing's going, because if you look at the rates and as they uptick, it's even upticking maybe 1/8 to 1/4 of a point. I mean, you start to see these applications drop significantly. And I don't see that happening 2 years ago, where people were that in tune with where the volume of and also the rate trends were going, because, people looking to save $50, $100, they're really looking at that, especially with refinances. So if you look at that whole picture, I think that rates themselves will consistently be volatile. I do think that they could creep up even more, but I do think that QE4 and something will occur after the election happens, and that's really going to dictate where rates are going to trend. Now, I do think that there's a possibility of a rate hike. I don't think it's going to happen, though. And you keep saying that that's going to be 1/4 of a point. I don't think the Fed funds rate raises at all this year.
We'll see.
Let's put some money on it.
Well, what do you want?
Let's put $100 on it.
Let's throw a deal on it.
Let's throw a deal on it.
All right.
Here's the deal. $100. Let's just go $100.
No, I don't want that fiat money.
Why?
I want that silver.
You want that silver? You and that silver and gold, man. You're a metals, a minerals guy, right?
I guess so.
Yeah, I mean, are you somebody?
I'm a precious metals guy.
Are you somebody that has the ability to understand that gold right now is what 16 times the value of silver?
That's correct.
So why would you buy silver or gold versus silver when silver's a precious metal too?
Well, the reason why I'm buying silver because it's undervalued. I know that, if it increases, I'm gonna triple, double, quadruple my money versus gold.
Well, let me say this: they got gold bonds out there. What do you think about that?
Here's the thing: I would rather hold on to my stuff versus having.
You're saying a tangible asset.
Correct.
You want an asset that you can hold
and I can see it, feel it, and if I need to trade it, I can.
You don't get that with a bond where they show you like, hey, here's a piece of paper with how much bonds you have?
Oh, yeah. Let me send you a bond right now.
You want to give me a bond?
Yeah, I'll give you a bond right now. I owe you what?
How much money do you got in the stock market, Chuck?
Nothing.
Nothing? You're not playing stocks?
Not playing stock. That's not my field. Real estate is my field. Why would I play stocks when I can make 17% returns and I have a tangible asset and I control?
But when you call a stockbroker, their job is to keep you in the stock market, right?
No, they're brokered than you. That's why they call it a broker.
They're brokered than you. As always, you can tune in here every Sunday from 11 to 1 p.m. We're giving you up-to-date information on a week-by-week basis on the market, housing market here in Las Vegas, the interest rates that's going on a week-by-week basis. Also, some of the challenges as a consumer out there, that if you're out there looking to buy a home, that maybe you can get some information from this radio show, and then it makes you armed. You go out there and you look for a property, and you find a property that maybe has some type of adjustment or some type of hiccup on it, where maybe it has things internally that have a problem. Maybe the financing is conventional only. Maybe you have a problem with doing a short sale. You're trying to get into a short sale and you have questions on that. This is all good information that we are dealing with in the trenches on a week-by-week basis, right, Chuck?
On a day-to-day basis.
On a day-to-day basis. And I'll tell you right now, it's stuff that we're trying to convey to you so that way somebody doesn't, you're out there, and if you're talking to a lender, you want a second opinion from me, just to see if you want to hold those feet to the fire on the current lender you're working with, just to see if they're not charging, high, I don't know, maybe some type of fees like we talked about. Yeah. You want to do that. So you want to get a second opinion. I highly recommend it. We're here every Sunday from 11 to 1 p.m. right here on KDWN News Talk Radio. We're here to make you smarter home buyers and shoppers. We'll talk to you next week.